In the digital wilderness of the modern world, there exists a silent observer. It doesn't sleep. It doesn't forget. It is a 3-digit number that dictates where you live, what you drive, and how the financial world judges your reliability. This is the story of your credit score. To the average consumer, this number feels like a final grade on their character. But in the cold, calculated chambers of high finance, it is something much more clinical. It is a predictive tool. It does not measure your worth as a human being. Rather, it calculates the statistical probability that you will become at least 90 days late on a payment within the next 24 months. It is a forecast of your future, written by your past. Behind this number lie the big three: Equifax, Experian, and TransUnion. These national credit bureaus are the keepers of the gate. They harvest data from your landlords, your creditors, and public records, assembling a digital profile of your life's choices. But how is this data translated into a score? There are two primary masters of the algorithm. First, the FICO score, the gold standard utilized by 90% of top lenders when making the most significant decisions of your life: your mortgage and your auto loans. Then there is VantageScore, a collaborative effort by the bureaus to compete with FICO, often the very model you see on the free monitoring apps that live on your phone. The architecture of your score is built upon 5 weighted pillars. The first, and most vital, is payment history. It accounts for 35% of the total. It is the heartbeat of your reliability. Next is credit utilization, the delicate ratio of what you owe versus your available limits. To the algorithm, keeping this below 30% is the mark of a disciplined borrower. Then comes the length of your history, the age of your oldest and newest accounts, the mix of your credit, a dance between revolving cards and installment loans, and finally, new credit, the frequency of your inquiries. Every time you ask for more, the system watches. Every move is recorded. But this system is not without its shadows. We must look closer at the black box, the proprietary algorithms that remain shrouded in secrecy, leaving consumers confused when their scores fluctuate without a clear cause. Even more concerning is the human cost. A 2021 study revealed that a staggering percentage of consumer reports contain errors. For the individual, disputing these inaccuracies can feel like shouting into a void, a process criticized for being slow, automated, and deeply burdensome. Perhaps the greatest tragedy of this system is the credit invisible. 26 million Americans exist in a financial purgatory. They have no history, and therefore no score. Because the traditional models have historically ignored alternative data, like the rent you pay every month or the utility bills you settle on time, marginalized communities are often locked out. It is a financial catch-22. You cannot get credit without a score, and you cannot get a score without credit. But the landscape is shifting. The Consumer Financial Protection Bureau, the federal watchdog of this ecosystem, is demanding greater transparency and fairer treatment. We are entering an era of soft data, where your Netflix subscription, your phone bill, and even your bank account's cash flow may finally be used to bridge the gap for those left behind. There is a movement to remove the stain of medical debt from these reports, recognizing that a health crisis should not be a life sentence of financial ruin. Your credit score is a reflection, but it is not the mirror. It is a tool, a map through a complex landscape. By understanding the forces that shape it, you move from being a subject of the algorithm to being its master. The numbers may be fixed in the archives of the big three, but the story they tell is still being written by you.